Hello everyone, and welcome to the 8th video in the FINA 5000 DCF Tutorial Series. My name is Harrison Ham, and in this video you're going to be learning two things. First, you're going to calculate implied share prices using the comparables data that you downloaded in the previous video. And then second, you'll be using the terminal multiples method to calculate an implied share price for your company. The first thing we'll do is use the comparables data to calculate implied share prices for our company. But before we can do that, we actually need to link the assumptions on this tab over to the assumptions on the other tabs. That way we have the data readily available for use in our calculations. So up here on the top left, we have 6 different things that we need to link over. The first 3 you'll link to the free cash flow tab, and then the last 3 you'll link over to the net income tab. So first, for shares outstanding, you'll find that up here in the assumptions. You can directly link that over. Same thing with debt and cash. They're both in the exact same spot. You should have to link them right on over to the assumptions in the free cash flow tab. Then next, for net income, EBITDA, and EBIT, you're going to link those directly over to the income statement. So for net income, make sure you choose the most recent year. So then you come down, there's net income. And then for EBITDA, you may actually have to calculate EBITDA because sometimes it'll do something like this where it just shows EBIT. And you have to actually add back depreciation and amortization. And if that's the case, then what you basically do is you take EBIT and then you add back the depreciation and amortization expense in order to get your EBITDA for the year. And then for EBIT, you should be able to just link that directly over from the income statement. So now that we have all the assumptions linked over to the other tabs, we can go ahead with starting to calculate the implied prices for our company. So what does that mean exactly to calculate an implied price? Well, we're basically going to be asking the question, what would Home Depot's valuation look like if it were valued the same way as its competitors? So to answer that question, we're going to use the median of these 3 ratios right here, and we're going to calculate what Home Depot would look like if it had the same ratio as its competitors. So the first step is to calculate the median valuation ratios for your company's competitors. So right here below the table, you're going to put a line for the median. And when you calculate the median, make sure you don't accidentally include your company in the calculation, because obviously you want to value your company as if it were one of its competitors, so you don't want to include it in that calculation. And you can just copy and paste that formula over for the next 2 ratios as well. And then we're going to use all 3 of these to calculate implied prices. So then down here below the median, we're going to put a line for the implied share price. And then we're going to make sure that's properly formatted. And then I'm actually going to start by calculating the price implied by the PE ratio, because it's a much simpler calculation than using the other 2 valuation metrics. So keep in mind that the PE ratio is a company's price divided by its earnings per share. So if we assume that Home Depot has the same PE ratio as its competitors, then we can simply multiply its competitors' PE ratio times Home Depot's earnings per share in order to get an implied price for Home Depot. So we take Home Depot's competitors' median PE ratio, and then we multiply that by earnings per share. So to calculate earnings per share, that's just the same thing as net income divided by shares outstanding. So we multiply by net income divided by shares outstanding is the same thing as multiplying by earnings per share to get our implied share price of $253. So what exactly does it mean that Home Depot's implied price is $253? Well, it's basically saying that if Home Depot were valued the same as its competitors according to the PE ratio, then it would have a price of $253. So right now, Home Depot's price is a little bit higher than that. So according to just this one ratio, Home Depot might be a little bit overvalued. But keep in mind that making a judgment call off of just one ratio could be a little bit hasty, but it's still a really good exercise to see exactly what Home Depot would look like if it were the exact same as its competitors in terms of evaluation. So for the other 2 ratios, we're going to do the same thing that we just did with the PE ratio, but instead of multiplying by earnings per share, we're going to be multiplying by either EBIT or EBITDA. And then what that'll leave us with is not actually the share price like it did with the PE ratio, but it'll leave us with the enterprise value that's implied by Home Depot's competitors. So once we do that, we can actually use the same method that we used before to go from the enterprise value to an implied share price. And then once we do that, we'll have an implied share price given by these other ratios as well that we can use to help value Home Depot. So first, we'll do the calculation for the EV to EBITDA. So we basically, again, just take the median of Home Depot's competitors on this ratio, and then we multiply that by Home Depot's EBITDA. So that cancels out the EBITDA effectively, leaving us with Home Depot's implied enterprise value. So now this little thing that we're multiplying together is the enterprise value, but we want to get from the enterprise value to the market cap. So to do that, we need to add cash and subtract debt in order to get market cap. So now we have the market cap of Home Depot, and then we divide the whole thing by shares outstanding in order to get an implied price. Then for the EV to EBIT ratio, it's the same calculation except we replace EBITDA with EBIT. So we take the competitor's median ratio, multiply it by EBIT, add cash, subtract debt, and then divide the whole thing by shares outstanding to get another implied share price. So looking at these implied share prices, all of them are significantly lower than Home Depot's current price of around $300. And the reason for that is because Home Depot's competitors are all valued at much lower valuations across all these ratios compared to Home Depot. If you look at the EV to EBITDA ratio, Home Depot has the highest one out of all its competitors. Same thing with the EV to EBIT, and its PE ratio is also fairly high compared to the rest of its competitors. So because of this, if Home Depot were valued like its competitors, its price would be much lower. So if you're doing an analysis of this, this says, okay, there must be some reason why Home Depot's valued more. Maybe it's they have more growth opportunities or they're more of a competitor in this market that's causing their stock to be a little bit higher valued compared to its competitors. So you need to sit there and think about why the valuations might be different. Because whether you're arguing to buy or sell Home Depot, you need to keep in mind that Home Depot has a different valuation compared to its competitors, which is something you need to incorporate into your analysis. And also keep in mind that these implied share prices are not valuations of Home Depot. They are actually saying if Home Depot was valued like its competitors, then what would it look like, which is not quite the same thing. For the next step in our analysis, we're going to be calculating a new share price by using the terminal multiples method. So this method is actually very similar to the method we used to calculate an implied share price using the perpetuity growth method, except the only difference is that we're going to do a slightly different calculation to calculate the terminal value. So because these two methods are actually so similar, it would be nice to just copy and paste all these formulas down. That way we don't have to actually retype all of them ourselves. But before we can do that, we need to actually make sure that some of these references are absolute, otherwise they won't properly paste over. So starting at the top and working our way down, first off with the projection period free cash flow, we need to make sure that both of these references are absolute. Then for terminal value, you can just ignore that because we're going to delete that in a second anyway. For the discounted terminal value, you want to make sure that these last two references are absolute, and that this first one, which references the terminal value, is not absolute. That way, when we paste it down, it'll reference this terminal value instead of referencing the old one. And then for enterprise value, you can leave that where it is. For net debt, you need to make sure that both of the references are absolute. For equity value, you can leave that how it is. Diluted shares outstanding needs to be absolute. And then finally, current share price needs to be absolute. And then you should have all the formulas properly formatted. That way you can copy and just paste them straight on down and it looks like it all worked properly. So like I said before, we're going to be calculating the terminal value for our company in a slightly different way from before. So under the multiples method, you're basically assuming that your company is going to be trading at a certain EV to EBITDA ratio at the time that it reaches its terminal year. And if that's the case, then we can just assume that in that terminal year, the company's terminal value is going to be equal to the enterprise value at that point. So it's worth noting the method we use to calculate the enterprise value here is the same method that we used on the comps tab when we were calculating our implied share price using the EV to EBITDA ratio. But the main difference is that here we multiplied by the current year's EBITDA, which gave us an implied enterprise value in the current year, as opposed to over here we're using the terminal year's EBITDA, which is going to give us an implied enterprise value in the terminal year, which we can then discount back into today's terms in order to calculate our enterprise value. So the reason for doing this is that it allows us to use a combination of projecting free cash flows and using ratios in our analysis, as opposed to just using projected free cash flows or just using ratios in order to calculate our enterprise value. So the question is, what EV to EBITDA ratio should we assume Home Depot will be trading at in its terminal year? The truth of the matter is that we have no idea what that ratio is going to look like just because it's so far away. But a good place to start is assuming that Home Depot will be trading at a ratio that's similar to its current competitors. So right now we're going to go up and finally finish filling out the assumptions on the free cash flow tab. Right here where it says terminal multiple, we're actually going to assume the Home Depot will be trading at the same ratio as its median competitor's EV to EBITDA ratio, which is the same assumption that we made when calculating our implied share price earlier. So now we are assuming that the terminal multiple will be 11.2 times the EBITDA. So now all we have to do to calculate our terminal value is multiply our assumed multiple of 11.2 times the EBITDA in the terminal year in order to get our terminal value underneath the multiples method. So the good news is we already have all of our other formulas already in place, so we already have our implied share price of $247, which implies that Home Depot currently is trading at around an 18% premium compared to the implied price, which suggests that it's overvalued. So the thing about the terminal multiples method is that it's really sensitive to two factors that you choose in your analysis. First, it's really sensitive to what you choose for your weighted average cost of capital, and second, it's really sensitive to what you choose for your terminal multiple. So in order to see what our implied share price might look like if we tweak those two factors slightly, we're going to create a data table. So the first step in creating a data table is to click on the top left corner of the table and then set that equal to your number of interest. So in our case, it's actually the implied share price is the number that we're really interested in seeing how it changes as we change these factors, the terminal multiple and the weighted average cost of capital. So now we need to give the table different values that it can use for the weighted average cost of capital as it goes through the calculations across each row. So for us, we used the blended WACC in our calculations earlier. So that's the WACC we're going to use here in our calculations for the data table. So we're going to copy it, come over here, and then we're going to paste it in the middle of the leftmost column of the data table. And the reason why we paste values here instead of doing equals and then come over here and set it equal to that is that if we didn't, then every time I tried to calculate a different row, it would change this number, which this is then referenced to, which would then change all these numbers, and then you get in this weird recursive loop that prevents the data table from functioning properly. So now we need to give the table the different weighted average cost of capital that's going to use in its calculations across each row. So we're going to go to the cell right above where we just pasted this hard-coded WACC, and we're going to do equals, reference that hard-coded WACC, then we're going to subtract off the WACC step, which is over here in our assumptions, it's around 0.5%, and make sure that this reference is absolute, so hit F4, and then hit enter, and then copy that formula and paste it right above it as well. So what this does is it makes it so that the weighted average cost of capital goes down by 0.5% each time you go up, and now we're going to do the same thing except we're going to be increasing the weighted average cost of capital by 0.5%. So we reference this WACC step, and copy the formula and paste it down. So we have an increasing weighted average cost of capital going up by 0.5% in each row, so that when we do the data table, we can see as we consistently change the weighted average cost of capital across these rows, how does the implied share price change as we go down the rows. So now when we tell the table what it's going to change for the terminal multiples, we're going to be doing basically the exact same thing. We come over here to the terminal multiple of 11.2, and we copy it, and then we paste values in the middle. And then we reference it and subtract off, except instead of using the WACC step, we're going to use the terminal multiple step, which is 1 times. And then we need to make sure that's an absolute reference, so make sure you hit F4. And then we're going to copy that and paste it over here. And then now we're going to do the exact same thing, except add the terminal multiple step. And then hit F4 on that, and then copy and paste it over. So now we basically told the table exactly what it's going to change across both the terminal multiples and across the weighted average cost of capital. So now we're actually ready to create our data table now that we have all of our information filled in. So you're going to select the entire chart area, excluding these data labels that we have on the sides. Then we're going to come up here to where it says data, and then go to what if analysis and click data table. So you have to put two things in here. The first one is the row input cell. So basically the data table is asking you, okay, so along the row, which is right here, what exactly do you want us to change? So for us, that's the terminal multiple. So we're going to come over here and we're going to select the terminal multiple, which was 11.2. And then for the column input cell, it's saying, okay, what are you changing along the column? And right here, our column is the weighted average cost of capital. And for us, that's the blended WACC. So come over here and select that. It's basically telling it exactly what it's going to change across the rows and columns. And if you did it properly, you should get a table that looks something like this. And you see that as the WACC changes, the price changes. And as the terminal multiple changes, the price also changes. And you can see, okay, so for this combination of the terminal multiple and this combination of the WACC, if we were to use those combinations, then we would have a price of around $280 for a company. So now we're going to create another data table for the implied share price that's created under the perpetuity growth method. So you'll remember that the first step in creating a data table is to put what the variable of interest is into the top left corner. So we're going to do equals and come over here and put the implied share price under the perpetuity growth method. And then next we need to input the values in the column. So for us, that's the WACC, and we can actually take the old ones that we just calculated and copy and paste them over, which is a much easier method than putting it all back in again. So next we need to input the perpetuity growth rate here into the row. And to do that, we come up here to the assumptions, click on the perpetuity growth rate, and then we right click paste values. Remember, do not set equals and then set it equal to that, or you get that weird recursive loop again. And then we come over here and we take the perpetuity growth rate and we subtract off the perpetuity step and then hit F4, copy and paste it over, and we then do the same thing, but we just add the perpetuity step. And then now that we have all the information in, we can select the whole thing and then come up here to what if analysis, data table, And then for the row input cell, that's the perpetuity growth rate, so we select that. The column input cell is again the blended weighted average cost of capital. And then ta-da, now we've created another data table for the perpetuity growth method. In this video, we use comp multiples to calculate implied share prices. Then, we use the terminal multiples method to calculate an implied share price for our company. Finally, we created data tables to analyze the underlying assumptions behind both the perpetuity growth method and the terminal multiples method of calculating implied share prices. In the next video, we're going to be making changes to the underlying assumptions of our model in order to get a better sense of what an accurate implied share price might be for our company. Thank you for watching this video, and I'll see you in the next one.